Co-investing alongside over 100 top VC funds completely changed how I think about investing. Not because I got access to better deals, although that obviously helps, but because I got to see how decisions actually get made behind the scenes. What investors focus on, what they ignore, where they disagree, and how often even the best get it wrong. Once you see how conviction really forms inside a deal, you start building a very, very different kind of judgment. Hi. I'm RUPA GANATRA-POPAT, founder and managing partner of Arāya Ventures and House of Arāya. I manage over $50 million in venture capital, and I'm backed by the British Business Bank. Across my angel portfolio and Arāya Ventures, I've co-invested alongside over 100 venture capital funds, which has given me a front row seat into how top investors actually operate. What surprised me most wasn't what I expected at all. When I first started angel investing, I thought the biggest advantage of investing alongside VCs would be access and protection. Access to better deals and protection from making bad decisions. I assumed that if a strong fund was leading the round, they had done the work, negotiated strong terms, and would actively support the company after investing. And while a lot of that is true, it's only part of the story. Because the real value isn't what happens before you invest. It's what you see when you're inside the deal with them. You see how decisions actually get made, and it's not what it looks like from the outside. From the outside, venture looks rational, like there's a clear process, a checklist, a logical yes or no. But inside a deal, it is very, very different. You see strong opinions held loosely, you see investors focusing on completely different things, and you see conviction forming in real time. What is especially interesting is how quickly the conversation shifts from, do we understand this, to could this become something very big? That shift happens fast. And even with the same round, there is often disagreement. One fund leans in, another passes, another says we'll wait and see. And that's not a flaw, that is the system. A good example of this for me was a company I backed very early in my angel portfolio. Several strong early-stage funds passed on the deal, but the team stood out to me. The market felt far bigger than the company looked on paper, so instead of waiting for validation, we helped build the round ourselves. 12 months later, after a few key milestones were met, a well-known US fund came in and led the next round at almost 5 times the valuation. And that was the turning point for me, because it made something very clear. Some of the best opportunities are the ones where conviction forms before consensus does. So what did I actually learn from co-investing at that level? There are 3 things that changed how I invest. Number 1, there is no single right answer in venture. You can have multiple highly experienced investors look at the same company and come to completely different conclusions. And all of them can still be credible. And once you see that up close, you stop looking for consensus and you start focusing on clarity. What do you believe matters? Because you don't need everyone to agree for a decision to be right. Number 2, pattern recognition, but not the way people think. When you invest alone, your exposure is limited. But when you're in deals alongside multiple funds, that exposure compounds quickly. You see more founders, you see more companies, you see more decisions and more outcomes. And over time, you start to notice patterns. Not obvious ones, but really, really subtle ones. How great founders handle unexpected questions. How clarity shows up early. How the best companies often don't look like winners at the start. But here's the nuance. Pattern recognition doesn't give you certainty. It gives you better judgment under uncertainty. Because even after seeing hundreds of deals, you still see great investors pass on winners and back companies that don't work. And that's not failure. That is just the nature of early stage investing. Number 3, the real risks are rarely the obvious ones. Early on, most angels focus on the product, the market, and the competition. But experienced investors look one layer deeper. They think about, how does this company raise its next round? Can the founders attract and retain talent? How does ownership evolve over time? And what happens if things don't go to plan? In other words, not just, does this work today? But what happens over the next 2 or 3 moves? Because most companies don't fail in obvious ways. They fail in second-order ways. And then there's something almost no one talks about, and that is deal structure. 2 investors can back the same company at the same valuation and have completely different outcomes. I saw this firsthand. In my angel portfolio, there was a company with a really strong founder. High conviction, real potential. But when it exited, the outcome was unfortunately below expectations. Some investors with preference shares got their money back. Others in ordinary shares got nothing. So even in an example where there was an acquisition, one investor got money back and the other got nothing. It was the same company, the same founder, and completely different results because of how the deal was structured. So things like liquidation preferences, pro rata rights, anti-dilution, information rights, these aren't just legal details. They determine your downside protection, your ownership over time, whether you can keep investing into winners. For me, this was one of the biggest mindset shifts. A lot of the game is played in the structure, not just the company. If this is the kind of thinking you want more of, subscribe. We share how serious investors actually approach deals. Not the conference version, but the real one. So what does this mean for you as an angel? Your goal is not to become a VC fund. Your goal is to become a better investor with your own edge. And for me, the biggest shift was this. I stopped treating co-investing as validation and started treating it as a learning environment. And yes, you really do benefit from better diligence, stronger networks, better deal structures. But that's not the real advantage because VCs are optimizing for their model and you're operating under completely different constraints. The real advantage is this. Learn how they think, pay attention to how deals are structured, use that to sharpen your own judgment, and that's what compounds over time. And if I leave you with one thing, it's this. There is no single right way to see a deal, and no investor has all the answers. What matters is how clearly you can think with incomplete information. When I co-invest alongside funds, I come back to 3 core questions. What is the fund's thesis and does it align with mine? What terms have they negotiated and am I on the same economics? How are they thinking about risk and why did they invest anyway? Those 3 questions will tell you far more than the headline valuation ever will. Because ultimately, the biggest benefit of investing alongside experienced investors is not access to better deals, it's access to better thinking. And once you see that clearly, you stop relying on other people's signals and start building your own conviction. I want to show you something we built specifically for investors who are already deploying capital. It's a free diagnostics questionnaire at House of Arāya. 12 questions, 4 minutes. It gives you a personalized read on exactly where your investment process breaks down across deal evaluation, portfolio construction, the quality of your access, and your discipline when the pressure is on. Most people find something they didn't expect. No pitch at the end, just an honest read on where you actually stand. The link is in the description below.